Hey, if you're looking to start a painting business and you need a set of financial projections, maybe for an SBA loan application or a potential investor, then you have come to the right place because we have created a financial projection template built specifically for a painting business. And I'm going to walk through how this template works, how to fill it out, and what the deliverable is, and make sure you feel comfortable before you go and present to potential lenders and investors. So I'm going to put a link in the description of the video below to this particular template so you can grab that and follow along. Also, if you stick around to the end of the video, as our thank you to you for sticking around to the end, we're going to give you access to a coupon code, our most up-to-date coupon code that you can use to take a discount on this template. And before I jump into the template, just a little bit more background on me. My name's Adam Huxama. I'm the co-founder of ProjectionHub. And before starting ProjectionHub, I actually spent a decade as the executive director of an SBA lender where we made over 1,500 SBA loans during my time there. So I come to this process of creating projections from a lender's perspective. And, during that SBA experience, a lot of our clients also had to raise equity from investors as well. So have a good understanding of how to present a set of projections to potential investors as well. Okay, so with that background out of the way, let's go ahead and dive into how this template works. Okay, so I am on the At a Glance tab here. This is kind of the end of the process. So wanted to kind of start with the end in mind here. Once you fill out all the assumptions, you're going to see a profit and loss at a glance table here, some summary data, some graphs and charts that you'd be able to pull into a business plan or a pitch deck. You're also going to get a 5-year income statement summary, a 5-year cash flow summary, a 5-year balance sheet, and then the income statement, cash flow, and balance sheet all broken down by month for each of the 5 years. So if you're applying for an SBA loan, they're typically going to ask for monthly projections for at least the first couple of years in addition to the annual projections. So we're going to give you the full 5 years just in case you need that. All right, so in order to produce those reports, we have a little bit of work to do though. And so I'm going to jump back here to our input assumptions tab and kind of walk you through. So the first thing you need to know is that any cell that's highlighted in blue is an assumption that you can change without breaking something in the model. And the other thing I want to point out at this point is we actually have created 2 versions of this template or filled it out in 2 different ways. And so when you buy the template, you're going to get access to actually 2 different variations of the template. It's really the same structural template, but filled out a different way. So the first way, and the way I'm going to walk through here first, is a single unit location or a single unit of the business. So imagine you start a painting business in one city, and then maybe in the future you actually want to expand your market and go into another city, add multiple units of the business. So this core template structure allows for that. It allows you to add in multiple locations. Now, for most folks, and probably if you are applying for an SBA loan, for example, you probably don't want to scare them away with your grand vision of, how you're going to have 10 locations by the end of next year or something like that, right? So a lot of times what I recommend is for a loan application, if you're just starting your first location, do a projection just for that individual location. But you can use this other variation that I'll show you at the end for a multi-unit business, just for your own internal planning and kind of seeing how this scales and over time, how you can plan for multiple locations. So, okay, let's take a look at the different input assumptions. So you can set the projection start month. If you have a current cash balance in the business bank account, you can put a cash balance in here. And now here's the location opening schedule. And so again, in this first example, we're just going to have our one single location opening on month 1. On the accounts receivable side, again, we're assuming this is a startup here. So we have 0 on the accounts receivable balance and no accounts payable balance, no inventory balance. So all of those you've got set to 0 here. On the accounts receivable section here, this average days sales outstanding, this is how many days it takes after you provide the service to get paid. And so this is probably going to depend on whether you're focused on residential or commercial. If you are residential, you're probably going to get paid right away or up front when you provide the service. So if that was the case, you could just put 0 here. because you're going to get paid on the same day. If you're doing commercial work, it might be that you provide the service and then you have to wait 15 days, 30 days to get paid. You might have to invoice and then wait to get paid. So if you have a mix of both, that's why we put 15 days in there. Maybe some of your residential customers pay right away. Some of the commercial customers take longer to pay. So that's going to impact your cash flow. And so that's an important assumption here. On the accounts payable side, this is on your expenses, how fast you pay your expenses. So we put 15 days here. We expect, some of your expenses, like when you fill up the gas tank with fuel, you might put that on a credit card. When you go get supplies, when you get paint, you might put that on a credit card and have some period of time, 30 days after you charge that to actually pay that credit card bill. So again, that can kind of help from a cash flow perspective. Starting inventory, this would just be the amount of kind of initial inventory you would want to have. So this could be, paint, supplies, really consumable items that you're going to use in the process of your jobs. You might have some initial inventory on hand. And then this is just make sure that you keep a supply of inventory on hand at all times. And so I'm going to just make that a small percentage, because probably what you're going to do mostly is go buy the inventory for each individual job. You're probably not going to hold a whole lot of inventory just on hand. So we'll put a small amount there at 10%. Okay, equity investment. So if you are looking for an SBA loan, the SBA is going to expect that you have some equity, some skin in the game. And so whether that's your personal investment that you're investing into the business, or you've raised money from outside investors, you probably should have at least 10% of the total project cost as equity. And a lot of times for startups, lenders are going to want even more. So in this example, we put in $50,000 in equity that we're putting into the business. And then down here, we have a startup loan at $75,000. So for a total kind of startup cost that we're looking at of $125,000. Okay, so here we have our fixed assets. And in this example, I put in a section here for leasehold improvements. Now, you may not have an office, you may not rent a space or a showroom or anything like that, but I wanted to show, if you, for example, let's say you did have a showroom that would allow customers to come in, look at different paint options, maybe see what it looks like on a wall or something like that. You could have a showroom, and you could, let's say you rented that out, and then let's say it was going to cost $25,000 to remodel or get that showroom up to the level that you want to show off to customers. So we have $25,000 there for leasehold improvements. And then tools and equipment here, we have $10,000 for tools and equipment. Now, if you had vehicles, if you bought a vehicle, you could put that vehicle here in fixed assets as well. I'm actually going to show in the model leasing the vehicle. It's a little simpler to model and just kind of have some base assumptions on the lease cost, but you could put in a purchase of a vehicle as well. Okay, so I've already showed the loan here, and we're saying we close the loan in month 1. We've got to start our first payment in month 2. We've got 10% interest rate over a 10-year term. Okay, so down here, you're going to see this green box that says, how much cash do I need? And you'll see your location here, the cost of the fixed assets from up above, how much working capital you're going to need, which is based on the revenue and expense projections that we're going to work on here in a minute. And so ultimately says, hey, you're going to need $35,230, and we've got $50,000 invested here in equity and $75,000 in debt. So we've got plenty of room, $125,000, and so we can easily cover these costs. And it might make sense in this, if this were the situation that you found yourself in, you might say, well, maybe I don't need to borrow quite so much. At the same time, it might make sense if you're able to borrow, that you might want to have that extra cushion to help you ramp up over a period of time. Okay, let's go ahead and look at our revenue tab now. So in this box, we're going to show when we hire painter 1 and 2. So we've got painter 1 and 2 here. Number of employees is 2 employees because we got both of those 2 painters, and we're hiring them in month 1. And then let's say we're going to expand. We're going to hire 2 more painters here in month 6, and then an additional 2 in month 13. And maybe we think, that's kind of the team. We think for this location, we're going to have 6 employees. And then we can say, okay, weekly work hours per employee is 40 hours. We're going to pay them $20 an hour. And then here is what percentage of their time is actually going to be billable. So of those 40 hours, how much are they actually going to be, what percentage of that are they actually going to be on the job doing billable work? And then here is what is the average hourly billable rate charged to customers. So as you think about how you price your jobs, obviously you're going to have the cost of materials and the cost of labor are kind of the 2 things that you have in going into pricing a job. And my expectation is that as you're thinking about how to price the labor component, you probably have a goal, an estimate in mind for kind of an average billable hourly rate that you're hoping to bill for the team member. So you're gonna have some idea of, okay, here's the job. We think it's gonna take us 10 hours, and so we're gonna charge $1,000 for the job because we'd like to try to make $100 an hour for our labor. So that's kind of the idea here as we think about how to charge for this. So I've got an average hourly billable rate charged to customers at $100 an hour. We're saying the average hours per job is 24 hours for the average job. So this gives you an idea of how many jobs per employee per week. Now you might have teams, right? So it could be that you might not have just one painter, you might have 2 of them on one job or 4 of them on one job, for example. And then here's the average revenue per job, the 24 hours times $100 an hour. And then here is the base revenue per employee per week. So in theory, if the average employee is going to have 36 billable hours per week, they should be able to generate 100 times 36 hours, so $3,600 a month or a week in billable revenue. Here's where we can build up like a ramp up period. So, and this is where that extra working capital could come in really handy. So months to reach full billable potential per employee. So as you hire new employees, you may not have the sales immediately to get them like up to full capacity. So for example, we could say, it's going to take 4 months for us to kind of build up. Every time we hire new employees, it's going to take 4 months to kind of get them up to that full 90% capacity. So here we have our annual price increase that we're going to charge to customers here at 5%. All right, so then next we have a handful of calculations and then our cost of goods sold section. We've already handled the direct labor portion because we have the labor related to these assumptions. We're paying the employees $20 an hour. They're working 40 hours a week, and we know how many employees we have. So this is calculating based on that 20 an hour and 40 hour work week, the average. And then we also have taxes. We estimated that to be 8% of their wages to go towards taxes and benefits. And then we have job materials per employee per month. Or really this, you can just think of this about as, what's your material cost average on a job. So if we say, we think typically 20% of the cost of the job is going to be spent on materials. So we could put 20% in here. So again, think about this. We're charging $100 an hour, 24 hours for the average job. So the average job's $2,400. Now out of that is going to come your material cost, right? So you're gonna have to pay for labor, and you're gonna have to pay for that material cost out of that $2,400 for the average job. So that's how that's going to work. And then we also put in a variable cost, fuel per employee per month at 3% of total revenue spent on fuel driving around to jobs. We set an annual cost increase. Maybe we'll bring that down. Hopefully inflation is at 3%. Okay, so that's it on the revenue and cost of goods sold side. Here is our operating expenses. So we can set things like advertising and accounting and credit card processing fees. And so you have a lot of flexibility here. You can set different categories of expenses. So you can create categories up here, and then they'll show up in this dropdown. We can say, okay, advertising is going to be sales and marketing. And we can set a cost driver. So you can set it as a percentage of revenue. a per location fixed dollar amount. So if it's like phone that you're going to have at every location, it's $100 and it's a per location expense. So you could set per location. And then corporate expense would be an expense that's not really tied to any individual location. So it wouldn't matter if you have one location or 5 locations. It's just the same fixed corporate level expense. Okay, so different ways to handle that. So accounting, for example, we set as a per location fixed expense at $500 a month because we think each new office you open or location or market you go into, you're probably going to have additional accounting expenses there. We have rent here, we have sales commissions. So if you're paying your sales team a commission, you can set that commission rate here. And then again, for the vehicle, we didn't put the vehicle on the fixed assets. We just put it in here as a percentage of revenue for a lease, which is a little more scalable. So as revenue increases, instead of trying to figure out, okay, now I need to get another vehicle here and another vehicle here, this vehicle leasing cost is just going to scale and increase as your revenue and business increases. And then the last input tab here is our salaries and owner draw tab. And so here we can set, let's say we have, you as the owner, you're going to take a $75,000 annual salary. You've got employer taxes, benefits of 10%, and you're going to start in month 1 taking that salary. And there is just one of you as an employee. And then let's say we want to add a manager. So we're going to add a manager in year 3, the beginning of year 3. So month 25 here, we're going to add that manager at $55,000 a year. And that is really it on this single unit location. So as we, once we've completed that, we can kind of see the results here, kind of just breaking even in that first year and then ramping up over time to a little over, 1.3 million in revenue, 233,000 in profit. Now, let me show you quickly our multi-unit location template, just so you can get an idea. So it's the same template, but we have just we filled it out differently so you can get a quick idea of if you wanted to model out opening multiple locations. So here we've got location 1, 2, and 3. Location 2, we're going to open in month 13, then location 3 in month 25. You could set equity investments tied to the particular location. Let's say we only need the equity investment for the first location. Then after that, the startup costs of the new locations are just going to cash flow automatically. You're not going to need to raise additional equity investment. On the fixed assets, we can set the location, leasehold improvements for each location and the equipment needed for each location and kind of layer that in. Now, here's an important point. This purchase month. So this says purchase month relative to location opening month. So since you have selected here that this associated location is location 2, the model's going to know from up here that location 2 is not opening until month 13. So when you select that you're going to pay for leasehold and for equipment here in month 1 of location 2, the model is automatically going to know that that means month 13. Okay, so think of this as like, this is the month that it's opening relative to when the schedule, it's the first month that the second location is open, right? And so it's going to automatically take care of that for you. And then you can have a loan down here as well. And the loan situation is the same thing. So if you had multiple loans for those additional locations, you pick month 1, but tie it to the associated, second location. It's going to know, okay, we're getting a loan when that location opens. Okay. So you want to check this green box again if you're adding multiple locations to be able to see, hey, do I have enough cash here, sufficient cash to open the location? Yes. And what we see here is that you actually have enough cash to be able to open those new locations just from your internal cash flow, and the profits of the first location help you open the second location. Profits of the first 2 locations give you the cash you need to open the third location. So, and that's how that is all working. Now, just to show you how this would work, Again, this is per location input. So it's assuming here that for the first location, you're going to hire the 6 painters in this order on month 1, 6, and 13. For the second location, you're going to follow the same pattern. So when you open the second location in the first month, you're going to hire 2 employees and so on, right? So the rollout is going to work kind of that exact same way. All of this is really exactly the same. You can see here now this revenue as it ramps up as you add in a second location here in month 13. Now we see revenue coming in from that second location and so on. And then this is all exactly the same as well. This looks exactly the same as well between the 2 variations. Now the salaries and owner draw tab, there's just one extra little section down here for this multi-location idea where we can set a location manager, for example, and have them, these would be people that would be hired as salary people for each location. So when you open a new location according to that schedule, it's automatically going to add a location manager starting on month 1 when you open that new location. So that is how this multi-location model will work. If you have any questions about any of this, feel free to reach out to us at support@ProjectionHub.com. Or if you are kind of watching this video and you're like, you know what, I know what I want to do. I just want someone to fill this out for me and where I can just describe my plans and someone can fill it out for me. We'd love to be able to help you with that. We do offer a template fill out service where we could fill it out or customize it for your specific situation. So feel free again to reach out at support@ProjectionHub.com and we can help with that. All right. Thank you for sticking around to the very end here. As promised, if you go down in the description of the video below, you're going to see a link to a form. If you click that link, fill out that form, we're going to email you our most up-to-date coupon code that you'll be able to use and take a discount as our thank you for sticking around to the end here. And then finally, if you found this video to be helpful in your process, we'd love it if you like the video, give us a thumbs up, subscribe to our channel. That helps us help more people. So we appreciate you and want to hope the best for your projections here, and just let us know how we can help. Thanks.